So you've got this brilliant business idea, right? You absolutely believe it's going to change the world, and honestly, all you need is just a little bit of funding to make it happen. You scroll through those TechCrunch articles, you know the ones, the million-dollar rounds, the crazy high valuations, and you think, well, if they can do it, why not me? Welcome to The Explainer. Today, we're going to demystify exactly how startup funding and valuations actually work.
But look, before you pitch a single investor, you really have to realize that startups generally fall into one of two very different baskets. On one side, you have the normal lifestyle basket, and this is great. You own 100% of your company, you don't take any VC money, you don't share control, and the business basically sustains itself. It's a wonderful, peaceful path. But on the exact opposite side is the explosive growth basket. Now, this means massive cash burn, giving up equity to venture capitalists, and aiming for an IPO or some huge acquisition. The reality is you simply cannot raise millions of dollars for a lifestyle business. It doesn't work that way. So today, we are focusing exclusively on that explosive VC route. If you actually want to build a unicorn, you're going to want to pay close attention to this.
Okay, let's dive into part one, the startup funding rounds.
Now, fueling that explosive growth we just talked about means spending aggressively, like often way more than your company makes, for years. Naturally, it'd be fantastic to just raise all that money up front, wouldn't it? But let's be real, nobody is willing to take the massive risk of funding your entire journey on day one. So what happens is you have to raise capital sequentially across these very distinct timelines. You're going to start with a pre-seed round, then you move to a seed round, maybe in years 1 or 2, then a Series A, and eventually a Series B and beyond. It's exactly like a ladder, and you literally have to climb it step by step.
And to actually climb that ladder, you have to prove your worth at every single stage. Think about what investors demand. At the pre-seed stage, they're honestly betting mostly on your team. Like, do you have the capacity to actually build the product? By the seed stage, they want to see real customer traction and exactly what your early growth tactics are. Then, when you go for a Series A, the stakes go up. You generally need over $1 million in annual revenue and some really deep, healthy growth numbers to back it up. And by Series B, well, you're expected to be right around the $10 million revenue range with a very clear strategy for how those investors can eventually exit and cash out. Make no mistake, you have to hit these exact milestones to convince investors to keep fueling your fire.
All right, moving on to part two, the reality of dilution.
Now, for a somewhat harsh reality check. As you move through all these funding rounds, you are essentially trading pieces of your company away. Seriously, by the time a startup actually reaches Series B, the founders rarely even own a controlling majority of their own business anymore. Someone else literally gets to approve your salary. The board could even fire you if you don't perform. Crazy, right? Which brings us to a fun little trivia question for you. Really think about it. When you finally convince a new investor to hand over millions of dollars, how exactly do you give them their shares? I mean, do you sell them your own personal shares? Do you just redistribute the existing percentages? Take a guess.
Let me explain this with a quick story. Imagine Walt and Jesse get together to build let's call it a math lab. They split the business 50-50, 10 shares for Walt, 10 shares for Jesse. Now, when they bring a shiny new investor into their startup, Walt and Jesse do not sell their original shares. No way. Instead, the company creates brand new shares, basically out of thin air, just for the investor. So Walt still has his 10, Jesse still has his 10. But because new shares were added into the total pool, Walt's 10 shares no longer represent 50% of the company. It's really simple. The pie got bigger, so their individual slice of the pie shrunk. And that right there, that is dilution.
Which perfectly leads us into part 3, understanding startup valuations.
So the big question is, how do we determine exactly how many new shares an investor actually gets for the money they put in? At its core, a startup valuation is really just like betting odds. It's founders and investors agreeing on risk versus reward. Let's anchor this with a very famous historical example. You know Peter Thiel, right? He was Facebook's very first outside investor. He gave Mark Zuckerberg $500,000 in exchange for 10% of the company.
Now let's look at how that math actually shakes out in the real world. If $500,000 buys 10%, it simply means the entire company is valued at $5 million after the investment happens. We call that the post-money valuation. Make sense? But that also means, right before Thiel's money arrived, the business was valued at $4.5 million, and that is your pre-money valuation. Imagine Facebook originally had exactly 100 shares, meaning each share was worth $45,000. To give Thiel his 10%, Facebook issued 11 brand new shares. So the company now has 111 total shares, Thiel owns his 10% chunk, and the founders, well, they are officially diluted. This brilliantly illustrates how cash directly converts into brand new shares based on a mutually agreed upon value.
But wait a minute, you might be wondering, How on earth did they know Facebook was worth $4.5 million before it had even made any real money? Well, the truth is, at the pre-seed stage, valuations are largely completely arbitrary. There is just no real mathematical way to value a sheer idea. The standard early valuation usually just sits somewhere between $3 and $5 million, and this is based entirely on the huge assumption that your idea has $100 million potential down the line. It's basically an agreement on your ability to execute as a founder, rather than any reflection of what's currently sitting in your bank account.
Okay, let's look at part 4, managing your funding runway. This ties directly into the single greatest existential threat your startup will ever face: runway. Runway is simply the amount of time, think of it as your cash cushion, that you have before your startup goes completely broke. It is absolutely crucial that your runway lasts long enough to reach your next fundable milestone. You see, so many companies literally die simply because they get stuck between rounds. Just imagine finishing your product but not launching it quite fast enough. You fall into this brutal catch-22. You're way too late to ask for more pre-seed money, but you severely lack the traction to justify a seed round. You basically become a sinking ship. And let me tell you, absolutely no investor wants to pour their money into a sinking ship.
So what do you do if you really need to bring in some early money fast to extend that runway, but you really don't want to get bogged down with expensive lawyers and super awkward valuation debates? Enter the convertible note. Guys, this is a brilliant, totally practical hack. It's basically just a loan from an investor that will magically convert into shares later on down the line. It allows you to completely delay putting a concrete valuation on your company until your next big funding round. It saves you time, it saves legal fees, and it avoids immense headaches when you should just be focusing on building.
Which brings us right to the ultimate question of the entire venture capital game. You really have to ask yourself, do you want to own 100% of a very comfortable $1 million lifestyle business? Or are you willing to accept the dilution, the immense pressure, and all that risk to own maybe 20% of a $500 million empire? Honestly, the choice is entirely up to you. If this explainer helped you finally see the matrix of startup funding, hit that subscribe button you're seeing right now for more content just like this. Keep learning, keep building, and I'll see you in the next one.